Hi everyone, and welcome to the solution video to problem number 1 here in Learning Objective 5-4. In this learning objective, we are talking about operating leases, and operating leases are different from finance/sales type leases in that this is a true rental agreement where we have an arrangement between a lessor and a lessee. So lessor is the owner of the asset, and then we have the lessee, who is the user or borrower of the asset. Now, it's a true rental agreement where you might have an asset that it has a useful life of 10 years, and the lessee is using it for 2 of those years. So if you remember in a prior video, we said that some leases are in substance sales of assets, but they take the form of a lease. So the legal documentation, the lease agreement, says lease, but in substance it's a sale of an asset. But here with operating leases, this is a true rental agreement, okay? And that is important because when we did the accounting for a finance or a sales type lease where we had a sale in substance, we accounted for it as a sale in substance. So the lessor removed the asset from its financial statements with a journal entry. And so this is going to be a little bit different in an operating lease because the lessor still retains ownership of the asset even though it's lending the asset out. So that's important here. All right, so let's erase this and make some room for us to work. And let's take a look at what this problem says. So on January 1st, 2024, Sans Serif Publishers, anybody catch that joke? Sans Serif Publisher. Sans Serif is a type of font. It's a font style. So I think this question is having a little fun with us. They leased printing equipment from First Lease Corp. So First Lease Corp is the lessor, Sans Serif is the lessee, and they give us a bunch of information about this lease. So First Lease Corp, who's the owner of the asset, the lessor, they bought the asset from CompuDeck Corporation for a cost of $479,079. The borrowing rate for Sans Serif for similar transactions, if they were to borrow money to purchase this asset, would be 10%. The lease agreement specifies 4 annual payments. That's important. 4 annual payments beginning on January 1st, 2024. The useful life of the equipment is 6 years. And Sans Serif pays for the right of control of the asset equal to the present value of the lease payments, which amount to $348,685. All right, so this asset is being used by Sans Serif. It belongs to First Lease Corp, and we're going to need to account for this for both the lessee and the lessor. Okay, so let's start with the lessee. So what happens on January 1st, 2024 for the lessee? Well, on that date, the lessee, and let's label this. Just give me a moment here. So I'm going to say, we're going to look at the lessee first. Okay, lessee. What happens on January 1st? On January 1st, the lessee records a right of use asset, and they also record a lease payable. Very similar to a finance lease that we talked about previously. And this is going to be equal to the present value of the lease payments, which in this case is $348,685. Okay, $348,685. $348,685. Okay. And then also on this date, because this is an annuity due, the lessee is going to record a reduction to the lease payable and a payment of cash equal to the $100,000 that they mentioned in the problem. So that is the annual lease payments. The first payment is due on the day of lease inception, so $100,000 here. And that is all of the accounting on January 1st, so only on January 1st for the lessee. What does this look like for the lessor? So let's look at the lessor. And we're going to look at January 1st as well. All right. Well, in this arrangement, we said previously the lessor retains ownership of the asset in both form and substance when we have an operating lease. So what that means for us is, while the lessee here is recording the right of use asset, the lessor is retaining the asset both in substance and form. So on January 1st, the lessor does not have to make an entry to remove the asset from its balance sheet. Now, this should sound funny to you because we're saying the lessee is recording the asset that it's leasing on its balance sheet, and the lessor is not removing the same asset from its balance sheet. So what that means is that both the lessee and the lessor have the same asset recorded on each of their balance sheets. So it's a little funny, and this is a result of the new accounting standards for leases that has come out recently. And the idea behind this new accounting standard is companies, if they are making use of leased assets to generate sales and profits, financial statement users should know to what extent there are leased assets being used to drive sales and profits. Okay, so FASB would like, even if the asset is leased, it would like that the lessee indicates the assets that are being used to generate its sales and profits. Okay, so it's a little anomaly here in accounting where we have the same asset being recorded by both the lessee and the lessor, because the lessor never removes the asset from its balance sheet. Okay. All right, but on January 1st, the lessee is making a payment to the lessor. So we want to record that. So we're going to say debit cash. And because the lessor has not earned this revenue yet, we're going to credit deferred lease revenue. Okay. So we're going to say debit cash 100,000 and credit deferred lease revenue because it's being made at the inception of the lease, and the lessor has not earned that lease revenue yet. So the lessor's entry is debit cash 100,000, credit deferred lease revenue 100,000. All right. So what's next here? So the next payment occurs on December 31st of the same year, and so let's just give ourselves some room here so that we can work on the next entry, December 31st. What do we do on December 31st? Let's look at the lessee first. So we're going to say lessee. What do we have to do on December 31st? So what happens? Well, the second lease payment is made. That's what happens. So we're going to credit cash, and the second lease payment is going to be for $100,000. I ran out of space here. 100,000. And if you remember, because this is not a costless transaction, so there is financing costs associated with this lease arrangement, and those financing costs are equal to 10%. So we're going to say our cost of leasing this asset is 10%. So we're going to apply the effective interest method, and we're going to say we're going to record interest expense, and this interest expense is going to be equal to the current balance of the loan, and in this case that would be the $348 685 that we started with, minus the $100,000 payment that was made on January 1st, and we're going to multiply that by the 10% annual rate. And because this is an annual lease payment, we don't need to adjust that rate. And so our interest expense here is going to work out to $24,869. And the remaining portion will reduce lease payable. So the difference between the $100,000 payment and the portion of that payment that is interest will be $75,131. That reduces the payable. Okay. Also, on this date, also on December 31st, remember the lessee recorded a right of use asset, so the lessee has to record amortization expense. So they're also going to say debit amortization expense, and we're going to credit right of use asset. And we're going to use the reduction, the amount that we reduce the lease payable, that will become our amortization expense. All right, because what we want, what FASB wants, the way that the GAAP rule was written, is we want the lease payable, we want this lease payable account as payments are being made, we want this lease payable account to decline as each lease payment is made. We want lease payable to decline at the same rate as the value of the right of use asset. So we're going to use the amount that the lease payable declines as our amortization expense here, okay? All right, so that is it for the lessee. What about the lessor? What do we do as the lessor on December 31st? Well, on 12/31, we got to do a couple things. The first is previously we had deferred lease revenue. We want to recognize that from the January 1st payment. So deferred lease rev, we want to just say credit lease revenue here as well. So that's 100,000. And then we receive in advance the second lease payment, so we have to again record deferred lease revenue for that second payment on December 31st. So we're recognizing the revenue from the payment made on January 1st, and we're deferring the $100,000 that was paid on December 31st. Okay, so kind of an in and out here, recognizing the January 1st revenue, recording deferred lease revenue for the December 31st cash payment. The last part here is because the lessor, and let's label this, so this is the lessor over here, because the lessor is, they retain the asset, because the lessor has retained the asset, the lessor now has to also record depreciation expense. So that is the last piece here. And let's just mark it off here. So we're going to say debit depreciation expense, credit accumulated depreciation, and this is going to be equal to this 479,079 divided by the useful life, which is 6 years. So this will work out to 79,847. 79,847. So I had to scrunch it in there. I apologize. So the depreciation expense is based on the value of this asset to First Lease Corp, which is the 479,079, divided by the useful life of that asset, 6 years. All right, well, this has been the solution to problem number 1 here in Learning Objective 5-4, where we've been talking about operating leases. Thank you very much for watching. I hope this video has been helpful. Take care.